The economy is clearly slowing. It's not my prediction anymore. It's a fact. If you look at initial jobless claims, highest 4-week moving average since September 2023. Continuing claims up by 15,000. That moving average is also the highest in quite a while. If you look at Philly Fed that came out today, if you look at retail sales, great disappointments. If you look at pending home sales, they're all not anywhere near as projected. They're all falling well short of the mark. I don't think we're in a recession yet, but we are tending towards that direction. And on the other side of the coin, you look at the markets. If you look at NVIDIA, it's adding the market cap of McDonald's every day. When you have a very narrow rally like this, it tends to mask what's going on underneath. For example, would it surprise you if I told you the equal weight S&P 500 is up 4%? That includes NVIDIA. It just doesn't overweight it because of its market cap. If you look at the Russell 2000, that's down year to date. There's 2,000 stocks there. So lots of cross currents, but the economy is clearly weakening. It's being masked by what's going on with the AI phenomenon in NVIDIA. All such narrow rallies have failed miserably in the past. You look at the Nifty 50, or if you look at the .com, but this is really a rally that's just like one stock. So the market's very narrow. The economy's clearly weakening. If you look at things such as financial conditions and credit spreads, and that's what I would really look towards to let me and my investors know when we need to get net short in the portfolio, they're still quiescent, remarkably. But this data that's coming out just over the past month or so is really starting to lend credence to the fact that we are slowing towards a recession. I think it's inevitable that we have a recession by the end of this year. Nothing has healed as far as the banking system is concerned. We have had the longest inverted yield curve inversion, so the 10s minus 2s inversion in history. The longest inversion, which really brings down net interest margins for banks, because how do they make money? They have to pay their depositors, but they're collecting interest on loans. Well, if the interest they're collecting on loans is equal to or less than what they have to pay on deposits, and if they don't want to raise their deposit rate, you have something called capital flight. People take their money out of the bank and they moved it to brokerage accounts, and a lot of money flooding into T-bills. So that's what's occurred. In fact, if you look at the reverse repo facility, something also I look assiduously at, is that has equated to the draining of that reverse repo facility, which is excess reserves from banks that was parked, laying fallow at the Fed. That has pushed, just in the last 12 months, $1.7 trillion of gambling money into Wall Street. So that money came out of the reverse repo facility, went in to buy bonds, newly issued bonds. That money is circling in the economy. And that's when you get, roaring kitty stocks going through the moon, and you have NVIDIA going up, the market cap of Berkshire Hathaway a few days. It's insane. But that's $1.7 trillion is now, there's only about $350 billion left in that reverse repo facility. And I'm really watching the bond market, because when that liquidity runs dry, and it's not too long away now, it's very close. Talking about months, not quarters. I think we're going to have a lot of problems in the repo market, in the money markets, in the stock market, and in the bond market. Those are the things I'm looking at, Don. Again, it's not time to panic yet. I'm just saying, if you're going hog wild over your skis in NVIDIA and going golfing and enjoying your life and saying, you know what, all you need to own is the number one stock in the AI phenomenon, you're in for a rude awakening. Because in my 33 years of doing this, being a licensed professional, this type of scenario has never ended well. And I look at something like the market cap of equities, total market cap of equities to GDP. It's 190 something percent right now. That's the highest reading ever, outside of like a couple of weeks immediately after COVID. So for reference, that ratio was 104% in 2007. It's almost 2 times more expensive. And in 2007, the market crashed by 50%, the S&P 500. Even though the bubble wasn't extent in equities, it was in real estate. And if you look at things like, how narrow the rally really is in the stock market. Because if you ask most people, they say we're in a recession and we're in a bear market. Because most stocks are down on the year. But if you look at NVIDIA is now worth over 10% of our entire US GDP. And if you add in Microsoft, NVIDIA, and Apple together, over 33% of US GDP. the total annual production and output of the United States is less than those three companies. That's insane. The total market cap of equities to GDP should only be about 50-60%. But now we have three companies representing over a third. So this is a very narrow rally. We're heading into a recession. Banking system is under a lot of stress. Net interest margins, commercial real estate, auto loan defaults are spiking. Credit card loan defaults are spiking, even higher than they were prior to COVID. Rate of change is really moving higher. And you ever ask yourself this question, well, why does Jerome Powell and the maniac people who run DC, Elizabeth Warren, people who run Wall Street, like Barry Sternlicht, who run real estate investment trusts, why are they crying? Oh, we need more rate cuts. Oh, please, you don't get it, Mr. Powell. Please cut the interest rates. I mean, inflation has risen to a point where if you look at some of these sentiment surveys, University of Michigan, I'll point out, the U.S. consumer is on its back. They've been wiped out. The lower three quintiles have been wiped out because of the inflation that's already happened. So maybe this might be news to our president, Joe Biden, but inflation isn't coming down the way he thinks about it. Prices aren't falling. The rate of change is falling. So if inflation went from 9% to 3.3%, that's still higher than 2, right, Dunnigan? But when inflation is rising at 3.3% from a level that's already wiped out the purchasing power of the middle class, how does that help them? And Powell wants to declare victory now and start cutting rates, not because he cares about Main Street, not because he knows when he cuts interest rates, home prices will go even higher and be even more unaffordable, and oil prices and commodity prices will boom, and we'll have more inflation. I mean, that's the risk he's taking when he's cutting interest rates, especially if he does it aggressively. But he's doing it to protect banks, because that's all he really cares about. And Janet Yellen, Treasury Secretary Yellen, says according to her, she thinks that the deficit and debt are in a good place. $35 trillion in debt, 125% debt to GDP, $1 trillion in interest payments, $1.7 trillion deficits. The debt to GDP was about 60% a few decades ago. Now it's 125%, 123, 125%, around that level. If the debt and deficits are in a good place now, when we have prosperity and the ratio, I'm not just talking about the outstanding debt, I'm talking about the ratio is growing. So the debt is growing faster than GDP. That's unsustainable, and she thinks we're in a good place. In good times, well, Janet, we're not in a good place. We're insolvent in good times. But when a recession comes, and I think it's coming, the data is telling me it's coming, and then unemployment rates spike, and then the automatic economic stabilizers kick in, and we have a $6 trillion deficit, who's going to buy it? Are we going to be in a really good place? Really, really good place then? So our leaders have gone insane, and all people care about is how good NVIDIA did today. But I mean, I don't do that. I try. My charter is to make money in good markets, bull markets, bubbles, and also to get the heck out of harm's way when I see a bear market coming that's derived from a liquidity crisis or a recession. And we are headed there. I'm not positioned for it yet, but I'm prepared to get there quickly. That's a question that doesn't really require, I mean, it's a question that you can't answer unless you say these people are disingenuous, they're using mendacity, they're prevaricators, they're liars. They care about one thing and one thing only, is their jobs and their position and to maintain power. And they'll do it at any cost. I'm not talking about someone who's uneducated and ignorant. A person who is the former head of the Federal Reserve, who is now the head of the Treasury, that tells you that the highest ratio of debt to GDP we've ever seen, and that's including World War II, the immediate aftermath of World War II, in good times, thinks that that's a good place and sustainable. I mean, you talk about incompetence. I mean, Joseph Goebbels is someone who comes to mind of, Baghdad Bob, who tells you, the news you think you want to hear instead of the truth. Hate to use those kind of alliterations, but you're just not getting the truth from these people.